Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to focus on the stock markets. No, not on where the Sensex or the Nifty is going to be a year from now or even a day from today, but rather on why stock markets all over the world, including in India, are making even the most dispassionate observers increasingly nervous. Is the nervousness warranted? Should governments and central banks do something about it? Or will markets do it for them? Joining me in the discussion are two experts, Sandeep Parekh, founder of FinSec Law Advisors, the Bombay-based law firm, and U. Ravindra Bhatt, Managing Director, Dalton Capital Advisors India, Private Limited. Welcome to the show, Sandeep, Ravindra. Let me start by asking each of you in turn, why are markets so out of kilter with macroeconomic fundamentals, both globally as well as in India? Are the reasons different in India? In fact, before I ask you why, let me ask you whether you think the markets are in fact divorced from fundamentals, and then ask you for a reason. Because if you look at both the Dow as well as the Nikkei is at a 26-year high. The Dow Jones sets new records every day. So let me start with you, Sandeep. A, are the markets out of kilter, and if so, why? Sandeep?
So really, I think there is really no way to say whether they are efficient or not. See, there are two definitions of efficient. One is they very accurately and exactly reflect what the true valuation of the market, underlying market is. Which again, I mean, there's really no basis to know what that exact objective number is, whether 30,000 Sensex is the perfect number or whether 31 or 34 or 25 is the correct number. The other way to look at it is, can you really predict the market? And in that sense, I think markets have always been efficient with few kind of abnormal days like that famous October in 1987. So it's very hard to beat the market, and to that extent, markets are truly efficient. You really can't predict. And I would say, I mean, who are we to sit in a studio and decide what the correct level of the Sensex or the underlying economy is? It's essentially a mixture of what the past prices, which are past information of companies, are already reflected in the prices. In addition, all expectations are reflected. Now, expectations might differ across people, but I believe in the wisdom of crowds in terms of millions of investors buying and selling and setting a particular price. There may be some disconnect between the general broader economy and the indices which may be reflective of only the top, let's say 30 or 50 or 100 stocks. So to that extent, there may be a little bit of they may not be exactly correlated to each other, but at the same time, I don't think we should try to second guess the wisdom of the crowds.
Okay, Ravindra, would you agree with that assessment? Because since the beginning of 2017, the BSE 500 has gained over 30%. Is that kind of increase sustainable when earnings are lagging? And even if you accept that markets are forward-looking, and Sandeep in fact says the markets are efficient, and who are we to sit in the studio and decide what is the right level? My question is that nobody can say what is the right level, but there's a broad sense, or whether in terms of at least PEs, are the PEs very way ahead of what the averages were? Should one drive looking at the rear mirror? Is there a sense all over the world, and why is it the economists, policymakers, everybody is getting just a little anxious that will there be a correction, and how sharp will that correction be? Because in fact, if markets were efficient, we wouldn't have had the global financial crisis. Ravindra?
Absolutely. I think the current level of valuations, which is probably at 22 plus PE on FY18 basis, is probably sustainable only if earnings growth come dramatically higher than what we have seen over the last 4 years, which is in the low single digit if at all. And we have to really step it up to about something like about 20% plus if you have to sustain these valuations. That doesn't look very likely as of now. But I think there is this binge of liquidity and leverage which is running the market to these levels. Whether it's Indian may not be so much in India, but at least in internationally, the post 2008 financial global financial meltdown, there has been a binge of liquidity and leverage, and that is what is playing out. And if you really see whether it was 1987 crash, whether it was the IT meltdown at the turn of the millennium, or the 2008 global financial meltdown, after the binge of liquidity and leverage, the withdrawal from there, has never been very painless, and we are now coming to the stage where this is started to be withdrawn in the US and probably is going to be withdrawn elsewhere also. So I think there is no painless withdrawal of a liquidity binge, and that is probably something that will bring some reality check to the level of the markets as it is today.
Well, regardless of whether valuations are stretched or not, Sandeep, the good thing is that after years of lamenting that Indians don't save in financial assets, and even those who do tend to never venture beyond banks, we now see retail investors discovering stocks, more correctly mutual funds, and through the SIP route. Equity mutual funds have added almost 5 million investor accounts in the 6 months ended September 2017. Roughly 5,000 crores has been invested in equity mutual funds monthly through the SIPs. That's roughly 60 to 70,000 crores per year. It is a newfound love of retail investors with markets vis-a-vis the mutual funds, of course, an unmitigated good at the micro and at the macro level, because the rising secondary market doesn't do very much for the macro economy.
Sure, just to kind of go back to the previous comment of Ravindra Bhatt, I think Indian markets, as he said, are quite different from the Western markets, which are kind of sloshing around because of excess liquidity. I think the Indian markets have changed quite dramatically. I think we've had changes in the economy. We've had changes in expectation of the future. We've had changes in how governance and government function. So, all the kind of macro pictures are really changing. And I think that mutual funds are part of that confidence that we are seeing, and I think it's I don't know if it's a great time to invest in the market today, but having said that, I mean, if you have a 10-year horizon, I think you really can't go wrong with the markets. If you have a 1-year horizon, it might be a terrible idea to invest in mutual funds today. But I think hopefully people are smart enough to invest for the long term, because equity is a perpetual investment, and unless you have the patience and the stomach for buying equity, coming in at, and again SIP, as you said, large inflows. SIPs indicate that people want to invest slowly and stay for the long term. So I would say it's a good trend, and the domestic market is extremely small. If you realize, even after all the bull run in mutual funds, we still have just 5% of savings get converted into equity. So compared to 40-50% in the Western world. So I think we still have a long way to go. It's I don't see kind of a crazy froth like we saw in the dot-com bubble, for instance.
Okay, well, that's heartening to hear. But Ravindra, do you agree with that, number one? And number two, FIIs today are much less important than they were a decade or so ago, when they could really hold the market to ransom, and not just stock markets, but also currency markets. Even so, they're very important investors. So are there any risks to macro stability? Yes, over the past few months, FII buying has been only a fraction of the domestic institutional investors. In fact, FIIs were on a spending spree in the last 3 months, selling almost 3 billion. Now, of course, they returned to the market somewhat. But so my question to you is twofold. Number one, is the newfound fascination with mutual funds of the retail investor a long-term trend, number one? And number two, are domestic investors now much more important than FIIs, so that we will not see the sharp reversal if and when FIIs lose interest in India? Ravindra?
Yeah, a couple of things. One is FIIs are really not as important as far as the direction of the market is concerned, as we have seen over the last several months, with domestic institutional investors taking the lead. But the fact that we need to remember is that there's a huge stock of equities held by FIIs. So therefore, if there's a dramatic movement out of Indian equities, that can make a huge impact, because even the sort of flows that we have seen in domestic institutions that can handle the sort of $1 billion or less of withdrawal from FIIs a month. But if it is double this, or if it triple this, then I don't think the domestic mutual fund flows are going to compensate this. That is one. The second one, as far as the flows into the domestic mutual funds are concerned, especially the equity mutual funds, which has been a phenomenon for the last several months, I think the issue here is this: that typically the retail investor gets attracted to a bull market at the fag end of the bull party, and probably that is what we are seeing today. Because if you see, they come in droves at the end of the bull market, and then there is a correction, and then you see that probably for the next decade they sort of nurse their wounds, probably withdraw, take the losses, and keep quiet. So this you have seen, whether it was at the turn of the millennium, immediately after the 2008 global financial meltdown, suddenly there will be a huge amount of disinterest by domestic retail investors in the market, and it takes probably the next generation to come and take fresh bets on equities, especially attracted by the next bull market. So therefore, it is difficult for us to say whether this is sustainable. There might be a dramatic change in terms of the retail investor, the young retail investors' attitude towards the equity markets, but if there is a huge correction, one can't take that bet that this will continue.
Absolutely, and that is my fear, but we'll return to this issue after the break. Please do stay with us. We take a very short break right now. Welcome back. You're watching Macros with Mythili, and I'm in discussion with two market experts, Sandeep Parikh and UR Bhatt, on what is really happening in the market. Can we make sense of it? Is it a sustainable rally? What justifies the valuations? Are the valuations excessive? But let me just return to the question, Sandeep, that we stopped with before the break. Because you said that you found the new fascination not likely to be temporary, likely to be sustained. And you don't think that is something that will disappear at the first whiff of a reversal, which is the nature of stock market investments. You have ups and downs. But you were fairly confident this is something that will sustain. Whereas Ravinder had a slightly different perspective. I was wondering whether you can elaborate on that, because the fact is that every time retail investors, the market turns, as Ravinder said, the retail investors, just pull out all their money, they retreat, lick their wounds, and it takes a long time before they return to the market. Why are you so confident, Sandeep, that this will not happen this time? Is it that we are seeing a different kind of retail investor, mostly younger generation, people who are willing to take more risks rather than oldies like me? Sandeep?
No, so I think it's kind of, let's start with the 30,000 feet picture. And I think if you look at the general trend of the economy, the improvement in the governance, top level corruption is dramatically reduced. Yes, there are several challenges, including those relating to capital expenditure in the economy, etc. But broadly, I think we are a large economy. We're growing robustly. We're expected to grow robustly. So I think I don't see a kind of huge downside in the economy itself over the next 5 or 10 years. Yes, instead of 22 PE valuations, you might have 15, 20, whatever else. So there is some limited downside, but I don't see a cataclysmic event, a black swan event, so to speak, which would hit the market. Of course, you can have a nuclear holocaust tomorrow morning, but short of that, really, there are no major events which we can, at least sitting here, expect. Which would change the PE valuations. I mean, there would be some play, but again, there's limited upside and limited downside today, I would say. But having said that, I think it's good that long-term investment, and we're seeing a lot of inflows coming from insurance companies, a lot of inflows coming from mutual funds, a lot of long-term money. And as I said, as opposed to regular mutual fund investments, we're seeing equity investment, surge in equity investments, and a surge in a subset which is the stickiest of all them, of them all, which is SIPs, which come in, which try to break that whole psychological problem of investors, which is entering at the peaks and exiting at the bottoms, which Ravinder had mentioned. So I think the signs are good, I would say, but obviously nobody can predict all the major cataclysmic events which are going to happen in the next few years. But short of something like that, I don't see much of a problem, and I see a good set of long-term investors who are entering the market and who will stay invested.
Okay, Sandeep, you obviously reflect the optimism of youth, but Ravindra, do ordinary retail investors really understand the risks in equity investment? Or, as you mentioned, will it be like the last time round, when after having burned their fingers, investors took a long time to return? Remember, we're talking about a society where there is no social security at all. So today people are attracted to the stock market because they see huge, upside. But one does not know what happens when this upside ends, because at some point of time, markets, regardless of whether there's a nuclear holocaust or not, do tend to reverse. They move up and down. That is the nature of the market. That's the nature of the beast. And it's always said that the seeds of the next bear run are always sown in the bull run. So do you think, Ravindra, that Indians really understand, and I'm talking about retail investors, even though they've come in through mutual fund route, do they understand that equity investment is a risky proposition?
Well, I don't think they understand the intricacies of this, except probably reading the disclaimer of mutual funds saying that equity investments can go up and down. But the fact is that there is, I think, enough statistics for us also to support that understanding the risks is probably not all that important if you are a real long-term investor, because in the 38-year history of the Sensex, if you have seen, there has been only one fall of more than 25% in a year. That is in 2008 when the Sensex fell by something like about 52.5%. But otherwise, most of the falls have been sub 20%. So therefore, it is not nobody's case that the market will collapse. But the issue is this, that, and again 75% of these 38 years, the market has given a return which is 21% per annum. On an average, and whenever there has been a lull, except these three events, 87 and the turn of the millennium and in 2008, there have been significant falls. But if you remove these three incidents, then I think the fall has been on an average of about 11% per annum, and if you take the total of 38 years CAGR, it's about 16% per annum. So actually nobody really has lost big money. If you're a very long term investor, you made money. But the problem is that you have to have the guts to accept losses in the short term when there is a crisis. When there is a crisis, when there is probably a 15% fall or a 10% fall, you should be able to stick around and have some judgment about the quality of the companies and the ability of the companies to effect a turnaround despite the slowdown, despite the crash in the market. I think that is what is really absent, and especially the retail investor at the first sign of trouble. In every bull market, every year probably you will see a 10% correction from top to bottom, from peak to trough. There is always a 10% correction. So, but you should be able to negotiate these 10% corrections without losing your sort of breath. But I think most retail investors tend to cut losses when the market falls by say 5-10%, and that's when they lose out on this long-term sort of compounding ability of the market. And that is where I think they get stuck, and then, as I said, they lick their wounds for the next 10 years and come back. And if you really see from 87 onwards, the first big crash that we've seen in living memory, you have seen every decade there's a crash, and probably we are at the end of this second decade of the 22nd century, and so therefore you see 21st century, and so therefore there is probably a chance that there will be a correction, a mild correction maybe.
Okay, Sandeep, Ravindra made a very relevant point that in the long term the stock market invariably rewards, but the small retail investor, he needs to have the staying power, and he needs to be willing to sit through the downsides as well. So my question here to you is that, is the regulator really doing enough to educate and prepare the retail investors for the very different kind of animal that is the stock market investment? We saw the recent SEBI move on consolidation of mutual funds, which is a very good move. So should the regulator do more such things? Sandeep?
No, I don't think it's the regulator's job is, at least the securities regulator's job is to, they're supposed to kind of make sure that nobody mis-sells products, etc. But and they do have an institute called NISM.
SEBI also has a development role.
It does have a development role. Yes. Yeah. No, so they do a fair bit of education. In fact, they have an institute which looks at educating the educators and passing the message. But I think more importantly, I think the quality of money which is coming in is quite different. And in fact, I saw a very interesting study just a year back in which somebody had seen virtually kind of since the 1970s till now, there's not a single 7-year period in which had you invested in the market, again not specific stocks but as a market, as in let's say a diversified portfolio, you would not have lost in any single 7-year period. And you would have recovered at least your cost of capital. Even had you invested in the peak of the dot-com bubble or 2007, you'd still have got cost of capital back. So I think that just means that certainly investors need to be educated that equity markets are good in the long run, and punting in IPOs for 2 weeks and all it's not really something which ought to be encouraged, which we as a country we have done. In fact, we've romanticized IPOs, making free money in 2-3 weeks. So I think we need to kind of move away from that and look at SIPs, which are, I think, a great sign of sticky investments.
That is true, Sandeep, but if I could just follow through with another question. Both Ravindra and you are, agreed on the fact that if you invest in the stock market for the long run, you are unlikely, or perhaps you will never lose it all. But we have the case of Japan, where it took 2 decades for the Nikkei to finally kind of come back to where it was 20 years ago. So are those very unlikely events, or should retail investors also be told that it's not necessary, that even in the long term, you may possibly lose? Should they be prepared for that, Sandeep?
No, so again, yes, Nikkei has been in a funk for 25 years, but I think that's kind of one of the exceptional countries of the world. And if you look at their economy, even the economic growth, if you look at the growth, they've been in a funk for many years, but if you see the per capita growth, it's actually positive because the population is shrinking. But anyway, as I said, Japan is a different, very complete outlier in terms of its demographics, in terms of how it's grown, in terms of the kind of negative interest rates which you see. And that's another thing which I'd like to point out, which is, the entire Western world has seen, from the 1970s when you had the oil shock till the till pretty much till very recently, they've always seen interest rates falling, and now they're kind of close to zero. So I think that's the secret sauce which they've used the markets have been frothy more or less almost all of that time, with those 2-3 exceptions. India, I think, also will see falling interest rates. So I think that's going to be a secret sauce of the Indian markets as well, and maybe that's what the investors are pricing in, falling interest rates, because if interest rates fall, the cost of capital, the cost of borrowing falls, and you can, it will have a kind of huge impact on the equity pricing.
Oh, absolutely. In fact, Ravindra, Sandeep said that it's interest rates, low interest rates are the secret sauce. But I'm not so sure there, because when it comes to central banks and interest rates, the question is, should central banks look at asset price inflation, keeping interest rates low with an eye on growth, or should it raise them in view of the danger of asset price inflation? Because you saw what the US did. Ben Bernanke, before him, Alan Greenspan, they all ignored asset price inflation. And that is what really cost us a great deal of growth in terms of welfare, because it clearly was not sustainable. But today, central banks are again focusing only on consumer price inflation, completely ignoring asset price inflation. Is that the right way to go, Ravindra?
Absolutely. I think central banks should be concerned about asset price inflation, because they need to have an opinion on this, because when valuations are completely out of skelter and there is a raging bull market with a potential fall in correction in sight, I think it is the responsibility of monetary authorities to do something about it, whether it is in terms of moral suasion, whether it is in terms of increasing the risk weight for lending to intermediaries, or in terms of margins that are minimum margins prescribed for lending to intermediaries or lending against stocks. I think these are the methods that they can do, but I think they are being concerned only about CPI inflation to the exclusion of asset price inflation is certainly not the way to go by, if history is any indication. And I think if the right sort of decisions had been taken even in the Fed at the right time, I don't think we would have seen the sort of global financial meltdown of the type that we saw in 2008. And so therefore, I think whether it is monetary authorities or whether it is regulatory authorities of any hue, they need to be concerned about asset price inflation when it goes completely out of sort of sequence and valuation going through the roof. I think they need to be concerned, because finally it is the local citizenry, the local investors who get affected. And now today, because of the larger participation of investors and citizenry in the equity markets, a big fall, a big correction is not going to have a limited impact like in the past. It is going to have a very wide impact among most participants, most of the citizenry. So therefore, I think the regulators need to be concerned.
Well, I'm afraid we've run out of time completely, so we'll have to end this discussion now. Both my experts are divided. Sandeep is far more optimistic. Ravindra is a little bit more guarded, and I think even though as an anchor perhaps I shouldn't take sides, I tend to be more on Ravindra's side, because clearly, ultimately what we've seen time and again is that the markets have the last laugh, and ultimately retail investors have to watch out for themselves. Thank you so much, Ravindra as well as Sandeep, for joining me in this discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now. In the meantime, if there's any topic that you'd like to see discussed in this program, do write in to us at the email ID you see at the bottom of your screen.